The VIX, or the CBOE Volatility Index, is the market's ultimate fear gauge. It measures expected volatility over the next 30 days by tracking option prices. When the VIX spikes, investors are panicking and buying insurance. A low VIX signals a quiet market. Essentially, it tells you if the market's heart rate is resting or racing in fear. The MadStocks Sentiment Gauge measures this fear by comparing short-term panic against long-term worry. It uses the VIX ratio to look at the next 30 days versus the next 3 months. In the green, investors are calm and the market is healthy. If that ratio spikes, it's a warning that a storm is hitting and it's time to be cautious. Professional traders use Bollinger Bands to identify extreme fear. When the VIX pierces the upper band, fear is overstretched, often a contrarian signal that a market bottom is near. Conversely, when the VIX is near the lower band, it reflects a calm regime where directional equity longs are favored. MadStocks also tracks the VIX against its 200-day moving average to define the long-term fear regime. If the VIX is elevated above this baseline, MadStocks provides clear, actionable insights. Reduce your position sizes and tighten your stops immediately to protect your capital as the trend shifts from calm to crisis. For the speed of fear, we use the RSI. When the VIX RSI hits 70, panic has likely peaked, signaling a potential stock reversal. However, a low RSI of 30 suggests the market is too quiet, a warning for pros to tighten stops as complacency sets in. Finally, the VIX/VVIX ratio measures hedging intensity. A falling ratio suggests hedging demand is cooling off and returning to normal, a powerful, all-clear signal that volatility will stay contained. Use these tools to stay ahead of the curve. Check the sentiment gauge on MadStocks today.